Welcome to Policy on Demand. I'm Pat Brown. The Financial Accounting Standard Board, or FASB, has weighed in regarding how companies complying with the OECD Pillar Two global minimum tax regime should account for the tax. Jennifer Spang joins us to discuss this new guidance and what it means for companies. Jen, welcome.
Thanks for having me, Pat.
Okay, so let's get right into it. There has been a lot of discussion around the accounting for Pillar Two, especially in light of the enactment of the rules in South Korea in December, although we know there's more action still to come in South Korea. What has the concern been?
I'd boil it down to two questions, really, from an accounting perspective. One is of timing, and then two is what do you do with it? So from a timing perspective, changes in tax law have to be accounted for in the period of enactment, which basically means that when something comes through and actually goes through the full process in the law, you need to do any relevant accounting in that period. The second then is how do you do that? And that has been a big question with regard to Pillar Two. The main accounting question there is whether or not Pillar Two impacts either the recognition or of new deferreds potentially, or the measurement of existing deferreds. So you take those two things together and you take something like South Korea happening in 2022, that created both a timing question and a how question.
Right. And so I understand Wednesday was a big day regarding this question. So what happened? Unpack it for us.
It was a very welcome day. So at a public board meeting yesterday morning, the FASB staff basically provided their view in response to a technical inquiry around the accounting for Pillar Two. And essentially the FASB staff has concluded that the minimum tax under GLOBE is an alternative minimum tax as addressed in the ASC 740, so the income tax accounting standard. And what that basically means is, as an AMT, there is no deferred tax impact. So at a date of enactment, there would be no remeasurement, there wouldn't be looking for new deferreds or anything along those lines. But rather, companies will essentially account for the impact of any top-up tax in the period in which it's incurred. So that is great news. We do have an in brief attached, and that includes the FASB's remarks, which were actually captured in board minutes. So that'll be available. That is available actually on the FASB site as well. So it was great news, actually.
So to the extent that you're a US GAAP filer, you would think about this from an IIR perspective, the sort of earlier portion of Pillar Two starting in 2024, let's assume, if you've got some companies in your structure where that would be relevant. And then you would think about this from the UTPR perspective starting in 2025.
That's right.
But that's US GAAP filers. So let's talk a little bit about on the international front. Can you share a bit about where the FASB's counterpart would be with regard to these kinds of questions that we've just been discussing?
Yeah, so the counterpart for the FASB is the IASB. And actually, the IASB has taken a different direction. So in January, they released an exposure draft consistent with a board meeting back in, I think it was November of last year. They released their exposure draft. The comment period goes until early March. Essentially, what that exposure draft does is it provides for a temporary but mandatory exception from any deferred accounting for Pillar Two until some unknown period of time, meaning the exception will remain in place essentially until the IASB either makes it permanent or removes the exception. This exception, I think, importantly, again, it's temporary. So that said, it's not like at a 1-year mark or 2-year mark. There isn't a time frame on it. It is mandatory, meaning there's not a policy choice. Everybody would be subject to that guidance. And it does come with a significant amount of disclosure. When you look at IFRS, unlike US GAAP actually has specific codified guidance with regard to alternative minimum taxes. That doesn't exist under IFRS. So that's just a fundamental difference. Albeit under old AMT, there really probably wasn't a difference in practice from what companies were doing. But that does leave a bit of a different path. That said, for a period of time with both of these boards taking their individual actions, will look very similar. So different paths, but in both cases, there'll be no deferred accounting when these laws are enacted, but rather you'd account for it as you described in the period in which you actually incur the tax.
That's really helpful. I want to follow up on one quick point just to make sure I have clarity around this, and that is the FASB's action. So I think similar in this regard to the IASB, the FASB's action is also mandatory. It's not that companies choose whether or not to do deferred accounting for Pillar Two purposes under the FASB. It applies to everyone who is a U.S. GAAP filer. Is that correct?
That is correct. So with the FASB's decision that it is an alternative minimum tax, the accounting as provided in US GAAP for an alternative minimum tax is really in the period, meaning no impact on the deferreds.
Yep. And so that's a distinction compared to, for example, the US GILTI regime, where the guidance has been that companies can choose whether or not to do deferred tax accounting.
Absolutely.
Yep. Okay, great. Well, we're going to have to leave it there. Jen, thanks so much for joining us.
Thanks for having me again, Pat.
Be sure to check out the link to the PwC in brief on this development included in the description of this episode. And as always, thank you for spending this time with us. We'll see you next time.